Good day, folks. Welcome to the second part of our discussion on relationship between revenues and costs. We're going to start today looking at costs. What are they? So let's create a very simple definition. As a cost is a payment of cash or the commitment to pay cash in the future for the purpose of generating revenue. Okay? Focus on that purpose of generating revenue. In managerial accounting, costs are often classified, or you might say organized, according to the decision-making needs of management. So how we lay that out is how are we going to use it? And when we look at that, costs are often classified by their relationship, correlation to a segment of operations, which I've previously called volume drivers. And in this section, I'm going to introduce the word cost object in addition. Now, a lot of times we look at these volume drivers, we're looking at them at a very high level in a company. Oftentimes, a company in management decision goes a much deeper level, meaning that they go at a deeper level. So instead of just tons of steel, what you might find is they go by which segment of steels that it is. How do they classify it? And you saw that in Module 1. But we're going to try to keep this fairly simple because once you understand the concepts, it's repetitive. So if I can figure it out for one volume driver, I can figure it out for all of them. Now, a company may have 10, 20, 30, 5,000 products, and these are all cost objects, volume drivers. But for analytical purposes, we often start at a high level of what these volume drivers are. Now, as I previously mentioned, that a cost object may be a product, a sales territory or department, or an activity, research and development, human resources, facilities. Those we call support functions. The simplest term in Module 1, I refer to cost object. I'm repeating this because I want you to see the connection between the two. The volume driver is simplest to learn the nuts and bolts, okay? And that's what we're trying to do here, is make sure you have an understanding of the process, what it is and why. And I'm going to introduce another company here besides Geneseo Coffee Company, the guitar making operations of Legend Guitars. And if you look at the process that we go through, and again, we'll be watching the process for a few things. A customer places the order, you get the materials. In this case, they have wood, strings, bridges, other things. Then they cut the wood, they assemble it, and then you have a finished guitar. So this is the process. We'll find two things here. There's costs that are associated with this. Remember, costs use cash, so cash goes out, but cash doesn't come in until you sell the guitar and get paid. So let's just focus on the costs for a little bit. We have two types of costs. We have direct costs and we have indirect costs. And cost objects or volume drivers, if they're identified with it, they're called direct or indirect. Direct are identified with and can be traced directly to a cost object. Okay? Then there are, that's, for example, the cost of wood used to make guitars is a direct cost. We can see the coffee beans is a direct cost. Indirect costs are those that you need to incur to produce the product. It's easily traced, but you can't necessarily find out how much is in each one. Many firms in cost accounting will attempt to do that, but that's an allocation of costs. And that could be any number of things. That can be utility costs to run the machine, supervision of the assemblers. So if I'm assembling a guitar, that could be a direct cost because I can make one guitar a day. Here's my salary for the day. You can directly tie that. But the salary of production are indirect. So the first step is when we're looking at cost from a production perspective, which is what we just looked at here, this process here, the manufacturing or production area, you don't always have to think about this as production. Okay, we could use a pizza shop as an example. You call in the order, okay, then you're going to have the materials, which is going to be your dough, your sauce, your cheese, your other vegetables that you put on it, mushrooms, sausage, peppers. Then you got somebody who's going to assemble the pizza, and somebody's going to put it in the oven. Then it's going to come out, it's going to go in a box, and then you're going to finally get it. So all of those costs can be broken into different components. So that's this direct, indirect. Keywords for you to know. One of the things you should be able to do when you're done with this is distinguish between what would be a direct cost of a product and indirect costs. And now let's come back, and I know this is a busy slide, but I want to walk through it. Again, some of it is repetitive, but these are foundational things. First thing is that concept in example. A cost object is anything for which a cost is to be calculated or makes you incur costs. Okay? I like to look at it, tie it back to revenue. Okay? How do you use it? Well, it helps to find where you're spending your money on that object. Okay? Is that product profitable? Can I manage and control costs? We'll get more into that when we get into standardized costing, looking at variances. Helps in preparation of annual reports, production reports. It helps us make rational managerial decision. So there's different costs, okay? And that's output cost, operational cost, and this operational cost can be the processes, the HR department, the technology support department. Business relationship, objects outside the company like customers. So what we do is we assign them, costs are assigned to a product or a volume indicator, cost of object, direct. They have a direct relationship. Indirect costs, sort of tracing is difficult, or it may not be meaningful. A different method is assigned. Okay, so that's sort of the introduction there. The cost of a manufactured product includes the cost of the materials used in making it, as I said, plus the cost of converting those raw materials into finished products. So we look at this, and the finished product contains three categories, if you will, with costs. The direct material cost, the direct labor cost, or the factory or production overhead costs. So we're now going to take a look at all three of these individually. So we're going to start with the direct materials cost. So this is the example again of Legend guitars, direct material, direct labor, factory overhead. Okay, again, start thinking in these terms. Everything begins with a raw material. Okay? When we get into service, you still have a raw material that oftentimes is the people. Hard to think of that way, but if you're going into the field of accounting, the raw material is accountant. Okay, and there's a direct cost of that, and that's your wages. So if I'm working in an accounting firm, I'm going to provide a service to the client, and what I'm doing is my cost is you, and I charge by the hour for you. So there's a raw material cost in service also. Direct materials cost, there's two requirements that have to go in here. They have to be an integral part of the finished product. Okay? They can't be incidental. And they got to be a significant portion of the total cost of the product. Okay? So again, we're entering into this dialogue of what's material, significant. Is significant 90%? Sure. Is it 10%? Maybe. So there's a lot of wiggle room here, but we always try to get as much into the direct material cost as possible. Here's an example that I've been using Geneseo Coffee Company, and here we have the fresh green beans, we roast them, and they become a bag of coffee, a pound. Okay? And that's what we're measuring. That's our cost object here, is a pound of coffee. So these are clearly material costs. And when we look at what ends up in the coffee, is it material? Yes. Is it an integral part? Yeah, it's the same. Okay? Now, we look at the direct cost of legend guitars, and we find the same thing. The direct materials are pretty easy to identify. Next thing is we have direct labor costs. Okay? And every process in an organization takes employees to do something. Employees are often the biggest cost of most organizations. A big piece of manufacturing, but in most other service industries, it is entirely people costs. It depends on the type of production that you have in a factory, and how much technology is used, and the relative relationship. But if you can directly tie an employee's wage to the finished product, it's classified as direct labor cost. Now, direct labor cost, that's more than just the wages that you pay the employee. There's payroll tax. That includes the federal unemployment, Social Security, Medicare costs, state unemployment. These are all based on percentages of wages paid. Okay? Then you have workman's compensation and disability insurance that the company has to pay for. You have health care benefits. You have retirement plans and other employee benefits. Now, when you look at all of these, there's a lot of variation in cost by person based on wage limits, based on what benefits they may select. So we tend to, this is an easy one to capture. These add a little more complexity to the situation. Now, for ease of application, these costs are often aggregated in human resources cost center and then allocated as a percentage of total wages. Okay, so at this point I may want to define that. How does an organization break down costs? How do they run that in the general ledger? They usually identify it as a cost center or a profit center. So a cost center is where costs are accumulated. Okay? And it's just a terminology of where you are recording it. So the wages can be recorded in a cost center where the workers are housed, and then a fixed percentage applied to those wages. We call that the fixed fringe. Much simpler and easy to understand, because if you think about it, the manager does not control these fixed fringe costs. They're controlled at a corporate level. Those decisions are made. So if we have as a firm $1 million of wages, these other costs, $300,000, and you get a fixed fringe rate of 30%. And that's generally almost, a lot of firms are more, not many are less than 30%. So if I want to add an employee or understand my costs, I know if I'm going to pay somebody $50, there's going to be these fixed fringe, which I don't need to understand them in detail because I don't control that. Okay? I can control the wages, number of hours worked, number of people worked, but I can't control that. So we use this fixed fringe. Somebody making 50, all I know is I got to add on 30%, which is 15 grand. That employee is going to cost me $65,000. And direct labor cost, again, must meet integral part, significant portion. Okay? Now we look at the indirect costs, and that's the production supervision. There's our cost object, the guitar. As we dig deeper, you're going to find we can build complex, I'll say, cost allocation models to assign these indirect costs to each unit. And that's called cost accounting methodologies, which we will get into as we move forward in the cost. Costs, other than direct materials and direct labor, are included in this manufacturing, are simply called factory overhead costs, manufacturing overhead, factory burden, all other costs of production. Either way, these are the costs that we know are associated with a cost object, but we can't specifically identify them. We know they're there, okay? All of these overhead costs are part of the product. We distinguish that from selling and general administrative cost, which we will continue to talk about as we move forward. So when we look at what goes into factory overhead, it's indirect material, indirect labor, others. So that's it. What are things that are in there? Factory supplies, lubricants and fuel, supervision of workers, experimental work, salaries of factory clerks. The big one, though, is right here. Rent, insurance, property tax on the building, maintenance and repairs of the machinery, power, heat and light, employee pay. These we've already talked about. That goes into the fixed fringe. Factory taxes, that could be property taxes, other taxes. So this is the other. So when we're going through, we're going to sort things down. Direct material, direct labor, and then overhead or all other costs related directly to production. So that ends this component of our discussion. Please let me know if you got any questions.